ARCC Capital Stock, ticker symbol ARCC. This stock is up roughly 3% year to date, underperforming the S&P 500, which is up 15% year to date. But of course, with this stock it is all about the dividends, with dividend yield at 10% and also 2 years of dividend increases. On the 25th of May, ARCC Capital presented quarter results where they missed on EPS and on revenue. For the upcoming earnings, most analysts think they will miss again. So what about the current stock price? Is ARCC stock a buy at current prices? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does ARCC Capital do? ARCC Capital Corporation is a United States-based closed-ended specialty finance company. Its investment objective is to generate both current income and capital appreciation through debt and equity investments. The company focuses on investing primarily in the US middle market companies. Revenue mainly consists of interest and dividend income received from the investments made. In here we see that core EPS was reported at $0.57, up year over year from $0.42, so this is looking pretty good. Net investment income per share was reported at $0.6 versus $0.41 year over year, also looking really good. Net income per share was reported at $0.52, up from $0.44 per year, which is also very nice. To me, this is very important with dividend yield sitting at 10%. You want them to be safe. Dividend paid is sitting at $0.48, so they can't afford the dividends right now. But keep in mind the payout ratio is very high, which is pretty common for these type of companies. Net asset value per share, a very important number with these companies, is at $18.45. For me, it is also very important that the company is very well diversified to minimize risks on this part. The asset class diversification looks really good to me, and so does the industry diversification. Software and services is by far the biggest segment with 22%. And in here we see the dividends coverage one more time. It is covered very well by the realized gains according to this data. And now that we know a little bit more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week, and also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. ARCC Capital is a 10 billion market cap company. PE ratio is around 15, which could indicate that they are undervalued right now. Later in this video I will show you my 3 price targets for ARCC, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 789 million, and in this graph we see that revenue went up really nice and steady. Over a longer period of time, margins are going up and down quite a bit. Ever since 2021, margins are going down, so that is definitely something to keep your eye on. Most recently, margins seem to be recovering. EPS is also going up and down over a longer period of time. It is not a bad thing, but I would prefer a bit more steadier and better here. Analysts expect 22% growth for the EPS in 2023, but take a look at 2024 and 2025. It is expected to see a -4% to -15% decrease. For the revenue, it is also looking really interesting. Analysts expect 23% growth in 2023, similar to the EPS, but also expect revenue to decrease at pretty high numbers in 2024 and 2025. Return on assets is sitting at -3.9%, which is a disappointing number. Return on equity looks good at 7%, but the most important number, return on invested capital, is sitting at 3.8%. which is also somewhat of a disappointing number. Current ratio is at 1.16, which looks pretty good to me. Over a longer period of time, it is always hovering between 1 and 2. Total debt is sitting at 11 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now, total cash is sitting at roughly 359 million, so they can't pay down a big chunk of their total debt, which is something that I don't like. But keep in mind, companies like ARCC issue a lot of debt to grow the business. So to me it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is at a negative number right now. But also historically it doesn't look very good to me, so this is a red flag to me. Shares outstanding are going up in the long run, which is something that I don't like that much. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 10%, which is an insane number. Annual payout is at $1.92 and payout ratio is at 83%. Usually I prefer 50% or lower, but with companies like this, 80% is pretty common. The 5-year growth rate is at 4%, which is an interesting number, given the fact that dividend yield is already at 10%. They also managed to increase dividends for 2 years in a row. And if you take a look at these numbers, the dividends paid since 2010, you see interesting things happening. We see big increases but also some decreases in dividends, so it's not really steady and consistently growing. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that over a longer period of time, payout ratio is decreasing a tiny bit, but since 2022 payout ratio is increasing again. I prefer 80% or lower with this company. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to stay at current levels. Overall these dividends look pretty interesting to me. But how about the historical returns? I decided to compare ARCC Capital Stock with the overall market, in this case the S&P 500. Next to that I added some competitors, OBDC, MFIC and Main. On the 5-year chart we see that ARCC outperformed the S&P 500 and all competitors by quite a margin. In total, ARCC returned 82%, including dividends. On the 1-year chart it looks pretty much the same. ARCC still beats the S&P 500 by quite a margin, and all competitors underperformed the S&P 500 in terms of returns. On the 6-month chart it is still ARCC that is beating the S&P 500. But right now 2 other companies are also having a higher return. OBDC and MFIC both beat the ARCC and the S&P 500. On the 1-month chart it's OBDC that is the winner here. ARCC has one of the lowest returns in this list. So bottom line, ORCC beats the S&P 500 and all competitors in the long run, but most recently it is lagging behind. So is ARCC stock a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 2, 3 and 4%. And to be honest, I'm being very optimistic here. For the profit margin I'm filling in 82, 84 and 86% based on the current performance. Since free cash flow margin is at a negative number, I'm again being very optimistic and put in the same numbers with the profit margin. Since over a longer period of time you want these numbers to be aligning. For the PE ratio and the price to free cash flow, I'm filling in 15, 16 and 17. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now ARCC stock is at $19. I hit analyze and we only see red numbers. We have a low price target of $13, which is a big drop from the current stock price. We have a mid price target of $15, which is a decent drop from the current stock price, and we have a high price target of $17. All these price targets are lower than the net asset value for the company, which is also very interesting. To me, the mid price target is the most justified here. I think they will grow at the same numbers as historically. This means that my final price target is in the range of $15, indicating that they are overvalued right now. My final conclusion on this stock is that from a dividend point of view, things look really interesting with dividend yield at 10%. But from a value point of view, I don't see the excitement. In my opinion, there are a lot of risks such as the free cash flow and revenue growth for the future. Dividends may seem very attractive, but in the future these might be at risk when the company keeps on going like this. For now, I'm skipping this stock since it's overvalued in my opinion and there are too many risks right now for me to invest in this company. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I'd really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.